So today we take a deep dive into the financials of the NIO stock to see if the current technology dive is justified or if it's just another 2015 mass panic triggering all these sell orders. Now I'm a long-term investor, so I don't really care if the stock takes a dive for no fundamental reason that is also not related to the business model. But of course I do hedge my bets occasionally when I expect a serious dip in the stock to make an extra profit. But this current NIO dip is fueled by the overall shift from growth stocks to value stocks and rapid increases in the 10-year yield. This gives the false impression that something is wrong with the company, and from looking at the stock price you would think that NIO just released the most terrible Q4 financials and a massive apocalypse is coming. So is that the case? Well, let's dive in and find out how NIO is really doing. NIO's Q4 results and performance. If we quickly glance over the NIO stock chart, we see that the share is trading at around $38, which equals the November of 2020 levels. Now if $38 is the correct value for NIO, and it already had this value since November, then that would mean that the expected revenue is already baked into the price, and that since November the future prospects of the company have not changed or have gotten worse. So we need to determine if this is the case and what the correct price for NIO should be based on its manufacturing and delivery results. From Q1 in 2020 to Q2, NIO went from about 3,800 deliveries to well over 10,000 deliveries, increasing deliveries by 169%. Now in Q3, NIO achieved well over 12,000 deliveries, thus increasing by 18%. And in Q4, NIO managed well over 17,000 deliveries, which is a 42% increase. So already these numbers look very good, even though the 42 might seem small compared to the 169, but you have to remember that it's % of a much larger number. So in absolute figures, this comes down to an increase of about 6,500 in Q2 versus an increase of about 5,100 in Q4. So it's much closer together. As you produce more and more cars, it's obviously not sustainable to be hitting increases in the 100% region. When we compare the Q4 deliveries to the previous Q4 of 8,224, we see an increase of 111%. So in just 1 year, NIO managed to more than double its Q4 output, which is an absolutely amazing result and tells us that NIO is doing just fine when it comes to increasing its manufacturing and delivery results. Before we continue with the profitability of NIO, please like and subscribe to the channel for more finance and banking information. Now, producing a lot of cars is great, but we are of course looking for profit. As investors, we want increasing future revenue streams with a healthy profit margin. So this means looking at the gross margin, which NIO calls the vehicle margin, and the operating profit margin, which NIO calls the gross margin. So in Q1 of 2020, the vehicle margin was at minus 7.4%, meaning that just the manufacturing cost of a single car was already higher than the sales price of that same car. This does not even include the overhead cost. So at this margin, you will always lose money even if you keep increasing the delivery numbers. Now in Q2, NIO managed to turn this around and achieved a positive 9.7% vehicle margin, which got further increased to a 14.5% in Q3. So we are now looking at a positive gross margin, meaning that if NIO starts producing more and more cars, it will become profitable. This profitable gross margin is sustained in Q4 by hitting a 17.2% vehicle margin, and this shows that NIO is well on its way to becoming profitable overall. In my earlier NIO shares will skyrocket video, I predicted that if NIO managed to keep the gross margin between 14.5 and 19.7% while increasing the vehicle deliveries, the company would easily be profitable in mid to late 2021. Currently, NIO is doing even better than expected, since the gross margin is at 17.2% and it's selling 30% more cars in Q4 than in Q3. So why did Wall Street get so upset over the Q4 results, and why were the headlines saying NIO missed earnings? Well, the answer to that lies in the relationship between R&D, operating costs, and the overall profitability of the company. In Q2, NIO did 44.3 million in gross profit, 77.2 million in R&D, and 132.6 million in general expenses. This all resulted in about a $164 million loss. For Q3, the loss was 139 million, with the following gross profit and major costs. Now in Q4, there was still about a $143 million loss, even though NIO had a massive $175 million in gross profit. So what went wrong? Well, if you take a closer look at the numbers, you will see that NIO had about $90 million increase in gross profit, but also increased the R&D by about 40 million and the general expenses by about 50 million. So this completely evaporated all the extra profit, and since the numbers from Q2 to Q3 were going in the right direction and the expectation was that Q4 would be even better, better, most analysts thought that NIO would significantly reduce its quarterly loss. This meant that they were looking for a loss below $139.3 million, and the company did about $143 million. So if you take this simplistic approach, you would say that NIO missed earnings. However, this completely disregards the fact that the company is in full control over these results. If NIO wanted, they could have met expectations since they did not have to increase R&D spending to deliver the more than 17,000 cars. This would have easily saved $40 million and reduced the loss to only $103 million. R&D is something you do to stay ahead of the competition and because you want to add to your portfolio of products and services. So NIO could do the same thing they did in Q2 and Q3 by keeping the R&D budget at about the same level. They clearly don't want to slow down their innovation, so they are slowing down their pace to become profitable. This is great news and means that NIO is well prepared for future technological developments. NIO's current assets total almost 3 times the current liabilities, so they can easily pay their short-term obligations, and this is why they prefer to spend the extra money on R&D rather than just sitting on it. So when will NIO become profitable? Well, the simple answer to that is if they deliver about an extra 17,000 cars per quarter, because as it currently stands, NIO delivers 17,353 cars per quarter and they make a gross profit of about $175 million. But they destroy this profit with $127 million in R&D and about $185 million in general expenses. So if they keep the R&D budget at this level, which don't forget they are in full control of, and let the general expenses grow at the same level as they did when they went from Q2 to Q3, you get a rough linear cost analysis that would give you about an extra $70 million of profit for every extra 17,000 deliveries. With the current loss at $142.7 million, you would need at least 2 quarters to reduce that. Now, since we know that the growth will slow down a bit in Q1 of this year, it will be up to Q2 to make up for that. However, even with a slightly slower Q1, the full Q3 should easily provide enough growth and profit to achieve an overall profitability of the company. So this would make NIO's share skyrocket after the Q3 results are presented this year. But before you start getting too excited, there are a couple of roadblocks slowing this process down. The main one being NIO's own management. If they decide to keep increasing the R&D budget, then it might take an extra quarter or even 3 before profitability is reached. Next to this, the lingering chip shortage and the general precious metal shortage that seems to be here for a while. It's unsure how long these will affect the profitability and delivery numbers, but eventually these will be resolved. So what do all these numbers mean for the NIO share price? Well, again, we have a simple and a more complicated answer. The simple answer is that NIO is extremely undervalued at $38. The company is in a much better position than it was in November of last year, and it is very clearly on track to become profitable this year. A fair value for the current financial results should be a share price of around $68, and if the Q1 of 2021 results show anywhere between 22 and 24,000 deliveries, a fair share price would be around $81. And when these numbers are going to be reached is anyone's guess in the current tech market decline. There seems to be a shift going on where investors are pulling their capital from growth stocks and putting it into value stocks. Next to this, the 10-year yield is rising rapidly, which is pulling even more capital out of growth stocks. This is all having a very negative effect on the Nasdaq and the tech sector as a whole. So all these moves in the market are making analysts and investors quite nervous, and this is exactly the perfect time for buying NIO shares. You don't want to buy shares when everybody knows exactly what they are worth. You want to buy them when the majority of the market is looking elsewhere and shares are not correctly priced. Don't take my word for it, this is exactly what Warren Buffett has been saying for years. Warren Buffett's Berkshire Hathaway bought BYD shares for just $1 in 2008, and these reached a high last February of $265, which is a perfect example of long-term investing in solid fundamentals. So my advice for the NIO stock is don't let the current volatility fool you into thinking that the company is in a bad position. Just focus on the quarterly results because the long-term outlook is looking great. As soon as NIO will allow the quarterly loss to decrease below $130 million, you will see a massive spike in the share price. And if they put a brake on the R&D spending, the company will be profitable by the end of the year. This will allow the current share price to easily double or even triple in the coming months. The NIO share price will show some serious volatility in the coming weeks, after which it will become clear what the settling level is, and this will be the ideal time to buy more shares. But if you are impatient, you can buy NIO shares today, since the 1 to 2 year outlook is well beyond the $100 and $150 target. This was the NIO stock Q4 analysis. Please like and subscribe to the channel for more finance and banking information.